What's going on, guys? This is Lior and welcome back to the channel. Now in this video, I'm going to be talking about what the differences are between active versus passive investing, right? Because everyone can benefit from having real estate in their portfolio, but for some people, it's better to be that active real estate investor that actually goes and buys the deals directly. Whereas for some other folks, passive investing, where you actually invest into other people's deals, could be the better move. So I'll talk about the pros and cons of each strategy, which can help you figure out what's the best move for you. So with that, let's get at it. What's going on, guys? My name's Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, if this is your first time on my channel, make sure you smash that subscribe button for me. I put out tons of new videos every single week talking everything about rental property investing, finances that deals with rental properties, and everything in between. So if that's the kind of content you're looking for, make sure you subscribe to the channel. So with that, let's dive right into it. And the way I'm going to break this video down is talk about active investing first, where I'll talk about the pros and cons, and then we'll talk about passive investing and discuss the pros and cons. And that way you'll get a balanced feel of the different strategies. So with active real estate investing, as I said in the intro, active real estate investing is basically when you yourself are gonna go buy real estate directly, right? So you're gonna go find the deal, you're gonna go finance the deal, you're gonna buy the deal under your name or your company, if it's a commercial deal, and you're gonna manage the deal yourself. Now, let's start with the cons of active investing, right? The main cons with active investing is that it is a business, right? This is certainly not a passive business where you just buy something and then collect distribution checks. That's just not reality. There are many, many different components that go into running a successful real estate business. And we'll go through them very quickly. It starts with deal sourcing, right? And with deal sourcing, there's many components involved to it, right? There's marketing, there's advertising, and depending on your strategy, if you're gonna go try and find leads direct to owner, how are you getting in front of those owners? Are you running direct mail campaigns? Are you running online ads? Are you buying leads, right? I mean, there's many different methods for that. If you're not going direct to owner and you're trying to go through brokers, how are you marketing yourself to brokers so that they think about you when they get exclusive good deals? So there's quite a bit that goes into this component of sourcing a deal. And we're not even talking about walking a ton of properties, right? Because even if you do get a good lead, you have to go walk a ton of properties before you find the right property that you yourself want to purchase. Then you're gonna have to also figure out the financing, right? You're gonna have to bring the right components of debt and equity to the deal. So with debt, you're gonna have to go make contacts with lenders, figure out exactly what kind of debt is right for the deal. Also, especially if you're doing smaller deals, you're not doing those mega large deals, you're not doing those mega large commercial deals. Typically the financing you get will need your personal guarantee, right? So you're putting your own assets on the line every time you sign a loan. And then there's also, of course, the equity side, right? Because unless you're gonna go buy very, very small properties, let's say $100,000, $200,000, if you're gonna play in the larger commercial space, or if you're playing in an expensive market like I am, I'm from Boston, right, where your average 3-4 family is $1 million, you're gonna need probably at least $250,000 to $300,000 in equity to get into these deals. And if you don't have that cash yourself, you're probably gonna have to raise that from third parties, right? So that's a whole nother complexity to it that involves a lot of investor management, again, marketing, branding, investor management and relations, proper legal docs. So there's just a lot of components that go into both bringing the debt to the table as well as the equity. Then you're also gonna have leasing and construction management, right? Because especially if you're buying value add deals where you're gonna do some sort of renovation to improve the value of the property, you're gonna need some sort of construction operations where you can manage everything efficiently and making sure everything is going smoothly. You're gonna then have to do a lease up of the property, and then again, manage proper real estate agents, make sure everything is going smoothly and the right tenants are coming to your property. And then once all of that is done, then you're gonna need proper property management and asset management once your property is leased out to make sure everything is kind of running smoothly on a day-to-day basis. So as you can see, there are many components involved in actually successfully running a active real estate investment business. So if that's the path you're gonna do, it's a fantastic path. but just make sure you understand it is a full-time business. Now, even though those are the cons of being an active real estate investor, there are plenty of pros to doing all of this work, right? If you are the active real estate investor, you are basically in control of the deal, right? So you get to decide when to sell or refinance the property. You get to decide cash management. You get to decide cash distributions between yourself and potentially your other partners or investors that are involved in the deal, right? So you are the one kind of calling the shots and in control of the whole process. By being that active investor. And not only that, there's also plenty of financial reward, right? If you can properly execute on a deal and you're the active lead investor. So if you don't necessarily want to be an active owner, right? Because of all those complexities that I just talked about. And again, the fact that you have to run essentially a full-time business to really do this properly, right? Maybe passive investing could be the right step for you. Now, what I mean by passive investing for the purposes of this video is essentially investing into someone else's deal, right? So you can invest into a partnership or a formal syndication where you're essentially going to become a limited partner and write a check for the required equity into an operator's deal. Now, the main pro with this strategy is this is basically as truly as passive income and as passive activity as you can get, right? Because your main activities that you have to do as a passive investor is write the check, collect your distributions, and then essentially send every tax season the K-1s from the property to your CPA to file. So the nice thing is, again, once you write that check, you're really collecting the cash distributions that are going to come from the property, right? Because you are going to have some sort of percent ownership in that purchased building. And you're also going to experience some of the really good tax benefits that come with investing in real estate, which is different from other strategies such as investing in REITs. So especially if you're a high income earner and you want to increase your income without necessarily increasing your income taxes, right? This is a great strategy, right? Because there's some great tax benefits that will help you offset some of the income earned. And as a high income earner too, really, probably you are pretty busy on actually earning that income, right? Whether it's you're employed or you're running your own separate business, right? You probably have a lot of things you need to focus on in order to continue to generate that high income. So starting a new venture in real estate that requires so much attention and has so much complexity may not necessarily be the best strategy for you. Plus, at the end of the day too, when you're investing into someone else's deal, especially if they're a seasoned investor, you're essentially leveraging their experience, right? So if you get to invest in someone else's deal that's been doing this for 5, 10 years or even longer, right? You are leveraging their experience in the industry, right? So some of the mistakes that you may have made if you were the operator directly could likely be avoided by going to someone else's deal that's already went through the ropes and knows exactly what they're doing and how to properly execute on the business plan. Now, there are a couple of downsides to being a passive investor. Typically, in order to invest into someone else's partnership or a syndication, what I typically see is that the minimum amount of money required for that is usually at least $25,000 and can range up to a minimum of $100,000 or even more, just depending on the size of the deal and how much equity is being raised in total for that certain acquisition, right? So if you don't have that amount of cash saved up, that's obviously going to be a disadvantage because you need that in order to invest in a lot of these partnerships or syndications. The other thing too you need to be aware of too is as a passive investor, you're typically going to get charged certain fees and that include acquisition fees, right? So those are fees that the operator charges when they close on the property, and that's to offset essentially costs for marketing, branding, putting all the legal docs together, the time involved in putting the financing in place, etc. You may have things like disposition fees or refinance fees, right? So when the building gets refinanced or sold, there's going to be additional fees because there's more work involved for the operator. In the middle during operations, you might have things like asset management fees, construction management fees, etc. Right? So those are all fees that the operator typically charges in order to fund their operations and make sure the deal and the business plan is all getting executed correctly. Still, even though you're getting charged those fees, most passive investors especially on value add deals, can see very, very attractive returns. Typically, you're starting to see at bare minimum mid-teens annualized returns. Usually at a low end, I see anywhere from 15% to as high as 20% and certainly up to 30% and much higher depending on the deal, right? So there's some really, really great upside for you as a passive investor to make some fantastic returns that you might not make in other sort of investment streams. So based on all this info, what you need to do as a potential investor is figure out what the right path is for you, right? And there's a lot of factors that go into that we just discussed, but the ones I would certainly prioritize, first of all, is certainly time, right? Because again, being an active investor is a massive, massive time commitment. It is a new business, and you're gonna have to sink a lot of time and knowledge to get going in the business. But if you're someone that's already got another business, or you're a high income earner, maybe the right move for you could be that passive ownership, because despite paying some additional fees, there is still amazing upside, as we discussed, for passive investors to make some really, really strong returns that they just might make anywhere else. Plus, this allows you to essentially put in real estate into your portfolio, right? Diversify your holdings into some nice and attractive real estate deals in different markets, in different classes of real estate that you like for yourself. So hopefully this is helpful, guys. Of course, if you have any questions, make sure you just put them in the comments below.